Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe, right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up in their names, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back.
Hey everyone, welcome back to the channel. Again, I am Mikeless for this video, so I do apologize if the audio is a little shaky. What I want to talk about today is high risk investing, low risk investing, and then what form of investing I typically go for. So we're going to start off the channel hot. I'm going to put you onto some new information, which is very, very important. So when it comes to high risk investing, these are for your young investors. These are for people who are able to invest in emerging markets. What is an emerging market? That's going to be companies that are emerging, right? Those are going to be newer companies. Like, for example, 10 years ago, Uber and Lyft. Those were emerging markets. We didn't know if they were going to succeed or not. And if you look at their stock market and you look at their 5-year, you may see that they're not doing so well, or maybe they are. I haven't checked to verify, but that's an emerging market. It has the potential to go up to the moon, and it has the potential to crater like a rock and be out of business, right? Because most businesses fail in the first 10 years. Most businesses, again, fail in the first 10 years. So if one was to succeed like Tesla did succeed, and it quadrupled, tripled, and quadrupled so many times, that is an emerging market in where you can gain so much money so quickly because of the risk factor involved in it, right? When you put so much money into something so risky, the ability for growth is unfathomable. Right? And so those are high risk investments. And I don't say trading, I say investing, because you're buying and holding on to something. Instead of buying it, selling it, buying, selling, buying, selling, that's a different form of, that's trading. That's not investing. I am an investor. And so when I speak, it's about investments. Cool. Moving on. Now, when it comes to low risk investing, that's going to be your bond markets. That's going to be your government-backed securities. That's going to be, I don't know if you would consider certificates of deposit low risk investments, because they do pay a dividend and they're backed by, again, the FDIC insurance that you should have on your high yield savings accounts. So if you have a certificate of deposit that's going to be backed by the FDIC, right? And so that's another form of, I guess, investing where you're earning interest, and it's very, very much protected. And in fact, the ability for that money to fall in a CD is not possible, but in a bond market is very slim, right? Because bonds don't move very rapidly. Those are for your older investors. Those are for people who are looking for stability as they get into their retirement years. Now, lastly, I am a medium risk investor. So what does that mean? That means I'm buying all sorts of companies. That means I might buy 1 or 2 emerging markets, depending on all the research that I did, depending on their future outlook, depending on the interest, depending on what they have planned, and depending on the capital that they have raised. All of those things is what I'm going to look at before I start to invest in a company that is emerging, right? And so when it's in the public eye, when it's in the public atmosphere, and when people are starting to learn about it, when it absolutely solves a problem and a need that I believe is going to be around for 10, 20, 30 years, then that is something that I am willing to invest in as an emerging market. Now, what is a safe bet for me? That's going to be my blue chip companies. That's going to be my stocks that have been around for 20, 30, 40 years and have been successful the entire time and continue to grow time and time and time again. Continue to employ more people, continue to expand, continue to build, and always have something else to reach for. Those are the companies that I absolutely love, that continue to grow, continue to pay me a dividend, and continue to be fruitful in my life. Now, a high-risk investment, those are going to be the individual stocks that I purchase, right? The Tesla, the Meta, the Apple, all those stocks that I purchase individually, those are high risk. But the way that I minimize my risk is by diversifying my portfolio. I have at least minimum 26 companies that I am invested in, including ETFs as well, which are exchange traded funds. And so what does that mean? That means that I am fully diversified amongst a bunch of companies. Although I am heavily invested in one or two other companies, there's no more than 10% of my portfolio in any company. In fact, most of them are capped at 9%, and none at the making of this video are over 9%. Now, am I telling you what to invest in? Absolutely not. I'm not your financial advisor. I'm just an average guy on YouTube who has averaged more than 3 times the returns of the average stock market year over year for the last 3 years. Right? And so when I speak, it is typically on the simple fact that I know what I'm talking about, that I've been doing this for over a decade, and that I have always beat the market. I have done what Warren Buffett said cannot be done. I have beat the market for 10 years straight. All right? So if you like this video, make sure you leave a like, comment, and subscribe. If you believe that I'm a medium risk investor, like I like to self-proclaim myself to be, let me know in the comment section down below. And what type of investor are you? Are you high risk? Are you low risk? Are you a medium risk investor? Let me know, and I'll see you on the next one. Peace.